This is the third leadership huddle of our 2022 webinar series. My name is Beth Mace. I'm the Chief Economist at NIC, and I welcome you to today's session. I'll be the moderator for today's session as well. We welcome your questions for our panelists during the discussion today. And if you'd like to ask a question, please submit your questions in the Ask Questions pane, which should be located in the middle and towards the bottom of your On24 window. We'll address submitted questions towards the end of the leadership huddle. So moving to our panel discussion today, I have to say it's a very exciting time in the senior housing industry as the sector continues to mature and product offerings become increasingly differentiated. Operators, developers, capital providers are increasingly segmenting the market by both price point and by service offerings, with decisions being made on whether they're going to serve high acuity residents through the end of their life or low acuity residents who are more interested in socialization and lifestyle. This really isn't surprising given the maturity of the senior housing sector. And it's not unlike what we've seen in other industries, such as the hotel industry, where you have a Motel 6 all the way up to the Ritz, or in the retail industry, where you have Costco all the way up to Neiman Marcus. So today, we'll be talking about three different areas of differentiation in the senior housing. First is the middle market product that offers care and housing options for the value-minded older adult. This is a segment that Nick has brought a lot of attention to in 2019 with our Forgotten Middle study. The study showed that very rapid growth in this specific cohort for seniors housing, and it provided insights into the care and the housing needs of that cohort and what they could afford. There's a lot of information about the results of that study that you can find on our webpage, www.nic.org, under the Research and Analytics tab. Second is the active adult segment. Active Adult offers amenitized lifestyle rental housing for what I call the younger old cohort. And this is the cohort that's really seeking community involvement, purpose, and connection. This segment is the focus of a lot of operators and developers today, both seniors housing as well as in multifamily, because they're focusing on the baby boomers. And the baby boomers were those who were born between 1946 and 1964. And today, in 2022, the oldest baby boomer is 76 years of age, which is ripe for the active adult cohort. And third is what I call the ultra luxury retirement segment, which is really emerging and growing as we speak. And these communities offer older adults high-end concierge lifestyle living options with wellness centers, sometimes 5-star culinary options, entertainment, and A-list cultural events. So I'm hoping that you'll agree that this is a really exciting and interesting time for our industry today as it continues to evolve. So I'm happy now to introduce our three subject matter experts for each of these property groupings. Today we have on our panel Melissa Andrews, who's the president and CEO of Leading Age Virginia. We have Ashley Fitzgerald, who's a principal at the Carlisle Group. And we have Tom Gaston, who's CIO of Maplewood Senior Living. So without further ado, Tom, let's start with you. Can you just introduce yourself briefly and a little bit about Maplewood and briefly on the Inspire brand that you're focusing on, and then we'll come back into more detail in a moment.
Sure thing. So I'm Tom Gaston. I'm the Chief Investment Officer at Maplewood, also a partner here. I've been with Maplewood for 12 years, and my group oversees all the investments, including deal sourcing, acquisitions, development, and construction. I've been in real estate for 35 years, and I feel like one of the veterans at this point doing senior housing for 27 years. I've had the privilege of being involved with the development and acquisition of more than 3,500 senior housing units. Maplewood started in 2005 in Connecticut, and we've had good fortune. We're now up to 17 properties. We operate in Massachusetts, Connecticut, Ohio, New Jersey, and New York. We have just about 1,600 units and a very high-end brand.
Great, thanks so much. Okay, Ashley, can you introduce yourself, please?
Sure, my name's Ashley Fitzgerald, and I'm a principal at the Carlisle Group. I've been with Carlisle for 15 years, primarily focused on multifamily, active adult, and retail investments in the Texas market. Currently, Carlisle has just under $28 billion in assets under management, of which $4 billion is active adult. And we have invested in a various array of products for active adults, from affordable to middle market to high-end luxury.
Terrific, thank you. And Melissa, can you introduce yourself and Leading Age Virginia?
Sure. Hi, thanks, Beth. I'm Melissa Andrews, President and CEO of Leading Age Virginia. I've been with the association for 6 years next month and been part of Leading Age for, this is my 20th anniversary. Leading Age Virginia is, thank you. Hopefully they'll keep me around for a little bit longer. Leading Age Virginia is an association of not-for-profit older adult service and supports providers here in Virginia. So we are the only association that represents the not-for-profit continuum. So everything from a small standalone adult day up to a large multi-site retirement community organization. And our core businesses are advocacy and education.
Great. Okay. So Melissa, let's stay with you for a minute. So Leading Age Virginia published something called the Middle Market Playbook. I think it was in 2020. Can you tell us about it?
Yeah, sure. So when I started with the association and was able to be on the road visiting our members and working with member boards across the country, it became very clear that people were struggling, organizations were struggling with how do we prepare for the largest part of the baby boom demographic, which really is this middle market, middle income group. And so I selfishly wanted to convene a group of smart thought leaders to talk about this because my parents fall into that demographic. My dad is a retired police officer. My mom's a retired secretary. They had no equity really, or little equity in their home, and they shared a pension. And so that was really the persona that we were looking at when we got together to prepare this playbook. And we worked on it for 2 years until we were able to publish it.
Some of the key findings in it.
Yeah, so it's interesting, the perspective that we were taking, and I'll tell you a little bit more about Leading Age Virginia's membership. We are really, about a third of our members are life plan or continuing care retirement communities, and our largest has 5 sites. So we are an association of smaller not-for-profit providers. So we were looking at how could our not-for-profit providers tap into this market, knowing that they don't have a ton of resources or large economies of scale. And so we first kind of developed the persona. We used the NIC study, the Forgotten Middle, to help us understand more about the demographic. And the playbook is really a roadmap for providers to use to begin this conversation, to say, if we want to get back to our roots of serving a different population, how do we go about doing that? And so the playbook really walks you through the leadership questions you need to ask, the mission and operational questions, all the way to we have a financial modeling tool that organizations can use to see, what it would cost to develop such a product.
And how big do you think the opportunity is in Virginia?
Well, I mean, I
Have
think
you been able to size it?
Yeah, I mean, I think your data shows that there's a huge opportunity nationally, right? I mean, we know Nick labeled it the Forgotten Middle for a reason. And I'll tell you, Beth, that what we were looking at was, for the poorest among us or low income, there's subsidies, right? That doesn't necessarily equal quality and it doesn't necessarily equal opportunity, but there is subsidized housing. For the wealthiest among us, we have options and choice because we can pay for it. So we were looking at how do we bring that not-for-profit mission to those who fall in the middle, who don't have enough for private pay, have too much for the subsidy, but would like to spend their latest years in community, being part of something, and knowing that when and if they needed more care and service, they would have access to it.
Yeah, so I thought it was particularly interesting and lucky for us to have you on the phone today and on the webinar because it's a topic that continues to need to be addressed, and I thought your playbook was really helpful. That would be served actually for the private sector as well as for the not-for-profit sector. So I think people, if they just Google it, they can find it. Is that right?
Yeah, if you go to leadingagevirginia.org, I think there's probably something right on the homepage that you can access it. So thank you. I mean, I think For us, for our members who participated in this, and for boards of directors and leadership teams I'm meeting with all over the country, this is something that's personal because we all have a family member who falls into this demographic, and we want to make sure that they have access to quality services and supports as they grow older. So I hope this helps as a conversation starter for organizations.
Yeah, I totally agree. Okay. So Tom, now at the other end of the spectrum, and keeping with the notion again that seniors housing is maturing, and it's maturing across price spectrum as well as service offerings and acuity levels, can you tell us about the Inspire product and the investment thesis? Tom, you may be muted.
I am indeed. I'm learning. So I could talk about this subject for hours, but I'll try to be succinct here. So our office is in Westport, Connecticut. We're about an hour outside of New York City. And we had an established luxury brand in the early 2010s. And we kept on looking in New York City, and we did not see really any viable options. And we kept on trying to do rehabs and different things. And it finally dawned on us that there was really no super luxury products available in New York, and for that market, or for that matter, in a lot of the U.S. markets. So we started studying it, and we finally came up with the concept of Inspire, and it was born in 2015 when we started the journey. So Inspire is intended to really feature bold design, exceptional care, intelligent technology, and immersive experiences. It's Inspire is meant to go into cities with huge barriers to entry and to satisfy a very discerning senior group who tend to be well-traveled, highly educated, and seeking and willing to pay for such services. So that was the inspiration of Inspire back in 2015. And we spent the better part of the last 5-6 years establishing the brand and what it wants to be. And we're very proud with where it is now.
So that's in New York. How big do you view the opportunity? Another opportunity in New York, or are you looking outside New York? How big is the opportunity as you see as you project into the future for Inspire?
Sure. I guess, initially when we looked at this, Beth, back in 2015, our hunch was that in a city of 9 million people, one of the wealthiest cities in the world, that would be able to attract 215 people. At the time, we were the first. There was not a lot of competition. So that was our thesis, and I think it'll prove out very well. Yes, New York can certainly accommodate more buildings. It currently has 5 to 6 offerings, and I know others will come. Not all of them are ultra luxury, but our goal is to certainly do at least 2 more in New York City, and we continue to identify opportunities on both coasts. Our second Inspire is actually going down in Washington, D.C. now, off of DuPont Circle.
Oh, that's a good location. Nice to work near there. So how do you view the competitive landscape on this? I mean, so you're one ultra luxury brand. Are there others or do you think there's going to be more coming in? How long will you be able to maintain sort of your position in the market, do you think?
I can't answer the question. I know one of the things that we're probably going to talk about is barriers to entry. And barriers to entry, the cost, the development cycle, the size of the project, and specifically what you're trying to offer, I think will keep a lot of groups out of it. Again, it's just not hospitality, it's just not real estate, it's just not operations. It's really an amalgamation of all three. And it took us, as I mentioned, 5 years to develop this brand, the whole infrastructure behind it. And that's a big deal. It cost us many millions of dollars. So I can't speak to who's going to come into the space. But again, you're talking about projects that are $200 to $300 million with a 4 to 5 year gestation period that have to be top quality in every regard. And it can't just be for the real estate or the hospitality. So I can't speak to the competition. We have 2 or 3 formidable competitors in New York now, and who also operate nationwide. But we still see vast opportunity.
And when is that New York property going to be opening?
Oh,
or has it opened
Beth,
already?
I'm sorry, it opened in March of 21.
Okay, and how have you guys been doing so far?
We're doing fine. We just crossed the 50% mark, I believe. And considering that we went through all the woes with COVID that all my colleagues on the phone, I'm sure, went through, that cost us about a year, and we lost a number of depositors. So the building was delayed about a year, but we're thrilled with the progress, and we're tracking pro forma.
Yeah, that was tough timing, right? Tough timing 1 year into the pandemic.
Right. And then, of course, New York State Department of Health was preoccupied with a lot of other things a year ago as opposed to opening buildings. It's not a slight against them, but when you think about the pandemic, their priority wasn't licensing new properties, but we worked through that very successfully.
Yep, I've heard that. Okay. So Ashley, we'll switch over to you for a moment. So Carlisle was one of the first companies to actually actively embrace active adult. And I believe, as you mentioned, that you have a higher end and a more middle market product offering. So similar to the questions I just posed to Tom, can you tell us a little bit about the investment thesis and then who the consumer is for active adult?
Sure, but real quick, Tom, I didn't realize that one of your locations was in DuPont Circle. I am in DuPont Circle, and I looked up your project, and it is in a great location. So congrats.
Thank you.
So, active adult. Our senior apartments are market rate 55 plus apartments. This product type aims to create communities with thoughtful amenities, activities, a light level of a la carte services that really foster socialization. And these communities are geared to target residents in their late 60s to mid 70s, which, as you know, is on the front edge of that wave of demand that we're seeing from the baby boomer generation, which ranges from ages 54 to 74. So this provides, steady demand for at least the next decade. And renter households in the baby boom cohort are growing at 8 times the national population growth rate, which makes the supply and demand fundamentals overwhelmingly favorable. Baby boomers, as I'm sure we all know, are also desirable renters as their incomes and net worth are largely insulated from GDP and stock market volatility. This leads to stronger collections, lower turnover, and higher occupancy. So these fundamentals are the basis for Carlisle's thesis for the active adult sector.
And how competitive is the landscape for active adult? I know in my circles, it's like the buzzword. Everyone's talking active adult, and it's being favored by multifamily developers as well as senior housing developers and operators of both. So how competitive is it?
I don't think that competitive field for the sector has been narrowly defined yet. I think there's still a lot of education happening. I know we're constantly looking for JV partners and developers in addition to the ones that we already have established. But the landscape really depends on, I think, the demographics for each market.
Do you think there's barriers to entry?
Absolutely. There's no one size fits all. And so just expanding a little bit on the demos for each market, we've developed a variety of products from affordable to high rise to infill products, cottage, wrap, podium. It all just depends on the market. It's not necessarily easy to build or figure out what to build, but once you have built it and leased it up, it's phenomenal. The largest risk is absolutely the lease up when you're trying to convince seniors to downsize and make a lifestyle change. But once the property is full, it's basically recession proof.
So how did it do during the pandemic?
It outperformed all the other sectors that Carlisle invested in during COVID in terms of occupancy, rent growth, and rent collections.
And do you have a reason for why that might have been?
No, I think our resident stickiness and the fact that their incomes are insulated from any kind of economic volatility allows them to stay in place, have more stability, and have more of a long-term plan. I also think despite the pandemic and quarantining, there was a level of socialization still, and you're really combating that loneliness that others would feel while just being in a single family home.
Okay. So I know that a lot of people think of active adult as sort of a cross between multifamily and senior housing. So how similar or dissimilar is active adult in terms of multifamily or senior housing, in terms of the lease up cycle, in terms of you talked about the stickiness of residents? How does that compare with multifamily in terms of the price points and things of that nature?
Sure. So the physical product is very similar to conventional multifamily. It just has an age-restricted component to it, which fosters that greater sense of community and socialization since residents are living amongst their peers. But it does not offer meals, transportation services, or level of care similar to senior housing.
And in terms of the resident, in terms of length of stay, so I think you said it's a, sort of a longer lease up cycle, but once they're there, they tend to stay. So is that like for 2 years, or does it go out to 5, 6, 7 years? What's that length of stay on average?
Yeah, no, our average resident length of stay is 6 years, and compared to conventional, where it's anywhere from 1 to 3 years.
Wow. How when you go to finance it with a debt provider, do they look at it more like multifamily or more like senior housing, or in terms of the terms of debt? Any sense of that?
I would say that the approach is definitely more comparable to conventional in terms of debt sizing and qualifications and evaluations of risk.
Okay. So now I think you guys have had some what I call round trips in the sense of deals that you invested in and then you've sold. So any surprises, or what's the pricing been? Can you tell us anything about lessons learned, how long the hold was, or anything? Because I think it's up to this point, active adult has sort of been an unproven investment thesis in the sense that there haven't been, again, those round trips. So any insights on that you can share with our audience?
No, absolutely. We certainly have lessons learned from a development and lease-up perspective. We held our first generation of active adult deals longer than anticipated due to the more challenging lease-up process, which, as I mentioned previously, involves a longer decision-making process for our residents who are likely relocating to be near adult children and or downsizing from a larger single-family home. So in many cases, it's a total lifestyle change. But the longer lease-up process ultimately leads to longer hold periods than previously expected. But the wait is well worth it once the properties are stabilized. Carlisle's portfolio has achieved an average of over 6% effective rent growth and 80% retention, with, as I mentioned, the average resident length of stay being 6 years. And as of today, we've successfully sold over $1 billion of active adults to mostly core funds. And I think the main difference between investors looking at senior housing and investors looking at active adults is that active adult commands more of a multifamily cap rate, or even a little bit more competitive than a multifamily cap rate. So you're looking, depending on the market, but you're looking at more of a 4% cap, whereas seniors tend to trade more around a 6% cap. But when you look at the risk-adjusted return, you can see that the return is much higher for that active adult product.
So I find that interesting that you're selling into core funds, because core funds are pretty conservative generally. They're perceived as steady income. You see it often in, when you're building out a portfolio in real estate, you have a little bit of office, you have multifamily. And in my experience, like, senior housing hasn't necessarily fit the core fund criterion, but active adult does if you're selling it into core funds, and that's pretty interesting to me. So and that's because of the sort of the stable income characteristics of it and pretty strong appreciation characteristics, it sounds like.
Yeah, absolutely. It's once these properties are full, you have residents that don't leave, that are able to continue to pay strong rent increases, and that maintain a high occupancy. So it's really a very predictable, stable stream of cash flow, which makes it incredibly desirable for these core funds.
Mm-hmm. And you were saying on average you've been able to generate 6% per year, right? For rent growth. That's once a year, I'm assuming.
Yes.
Mm-hmm. Wow. Okay, that's really helpful. Thanks. Tom, over to you for a second. So, when you go to borrow money on ultra luxury, how do lenders perceiving this as an opportunity? Is it more like traditional multifamily, as Ashley was saying, for active adult, or is it viewed as more risky or less risky, or where does it fit?
So I get to duck this question a little bit. So we've actually had the good favor or good fortune of doing all of our transactions with Omega Healthcare REIT. So all of our structures are done through a REIT structure, and we have not been in the debt markets for years. So we're not kind of subject to the whims of that and or the underwriting criteria. Certainly Omega has rigorous criteria, but we have not played in the debt markets.
Okay, that's great. And do you have any expectation for how the returns will compare on annual returns might compare on sort of the Inspire brand versus other Maplewood product?
It's interesting because the Inspire brand has a lot longer development and gestation period. Or with COVID, it ended up taking us about 6 years in New York. It should have been about 5 years, and a typical suburban project might be 3 years. So obviously, there's higher risk, there's higher carry, but higher reward. And the way we've been looking at it, both either return on cost or IRR, we think they're going to be very similar. That's the way we've been looking at them for years.
Mm-hmm. Okay. Okay, Melissa, over to you. In the not-for-profit CCRC world, how is success measured? Is it measured by financial return? Is it measured by occupancy? How do you guys usually think of it in terms of a successful project?
Yeah, so I think both of those, as well as impact, right? So lives served. We like to look at both what the impact is within our walls and the impact outside of our walls. So defining community with a little c and a big C, because it's not for profits. We have a responsibility to influence the community at large as well. So certainly we're looking at financial outcomes, we're looking at quality outcomes, resident and employee satisfaction numbers, and we're looking at how many lives are we serving through our mission, and how do we grow, sustain, and amplify that mission on a regular basis.
Do you think that as a not-for-profit community that you have any advantages or disadvantages over a for-profit, or do you think that you attract a different type of client or resident?
Yeah, so, such an interesting question, Beth, because does the average consumer know the difference between a not-for-profit and a for-profit? And the answer most likely is no. However, the average lifespan of our members is 75 years. These are organizations that have been operating within their communities for a very, very long time. And therefore, you have consistent leadership. You have consistent staffing. We're governed by volunteer boards of directors who are members of their community. So I think from a reputation perspective, from a mission sustainability perspective, continuity of leadership, so I think that there, as you've heard with Tom and Ashley and myself, there are different models out there for different people. And I think, all marketing is local, right? So it really depends on when you're looking at a geography where you want to live as you grow older, or where you hope your parents will live. That geography is a huge driver in decision making, no matter what the tax status is of the organization.
Right, that's a good point. So I just want to remind the audience, if you have questions, you can go to the lower box on your pane, lower parts of your screen there, where it says Q&A, and you can submit your questions. So Melissa, staying with you, it was interesting what you just said, that you're long established, you have leadership that hasn't changed. So sort of the big topic in our industry, of course, is labor and staffing. So is that something that is a particularly significant challenge for your communities that you work with?
Oh, absolutely. I mean, workforce is the number one thing that keeps everybody in every industry and every sector up at night, right? I mean, you show me a sector that doesn't worry about where they're going to get their workers from, and they're either in denial or they're working completely with robots. I don't know. So yeah, certainly, how do we continue to recruit and retain, the most highly qualified workforce is definitely a huge challenge for us. And the competition has changed, right? So my members aren't competing against Tom's communities and Ashley's. We're competing against retail. We're competing against hospitality, restaurants. For us, particularly on the healthcare side, we have a lot of work to do on continuing to value and promote the value of those frontline caregivers. And so certainly we're seeing that across long-term care, the challenges in recruiting the clinical side, but then we also all have challenges on the non-clinical side. When you look at the churn that you might see in your dining offer in terms of servers and people working with dining, I think we're all seeing that churn.
So any observations that you've made that you could share with us in terms of how some of your communities are addressing that more specifically?
Yeah. I mean, living wage, certainly, increasing wages, taking a fresh look at benefits in a way that we haven't before, right? So the benefits that I might value in my role are not necessarily the benefits that are valuable to a CNA or a director of housekeeping. So we need to look at the benefits equation differently. We certainly have to look at culture, right? Healthy cultures are what keep people in organizations for decades. And so that healthy culture stems from consistent leadership, right? Person-centered care, both for the people that you're serving and for those who are serving them. I think, so we're trying to maintain competitiveness on the financial side and the benefit side, but also making sure that we're offering career development opportunities, whether that's career ladders or career lattices, tuition reimbursement, pet insurance, looking at what the paid holidays are through that diversity, equity, and inclusion lens in a new way. So there's no silver bullet. I think that everybody's looking at this through every side of the prism that they can in the hopes that we develop some things that stick. And the last thing I would say is speeding up that process from application to hire and making sure that we can, the day that we can offer people a job, they can start work the next day again, so we don't lose them to Chick-fil-A or Walmart or insert any business name.
Yeah, we have a survey that we've been conducting since the pandemic began called the Executive Survey Insights, ESI. And one of the questions we've been asking is retention and how FTE that you hire, how long do they actually stay? And it's pretty shocking at the churn rate that staff have. So, my takeaway from that is how important it is to, once you recruit and you actually got that person, how important it is to retain. And that's, yeah. I think a lot of your points are really well taken, that we have to understand that the values and sort of the benefits packages for individuals that are on the front line might be different from an individual that's in a management position, and to really understand better and be more in focus with what the needs of the actual staff are. So
and also
helpful.
we need to train our supervisors. So we need to make sure that as we're promoting people into supervisory roles, they know what that means, because the reason that people leave most often is their relationship with their supervisor. So we need to invest in that middle manager role as well.
Yep. So Ashley, that's not probably as big an issue for you with your properties at Carlisle. Tell us about how many staff usually are associated with a property if it's an active adult.
So it depends by property and by market. For our Overture product, which is our development with Greystar, that's more of a luxury multifamily active adult product. There we'll have 5 to 6 full-time employees, and that's really because we're staffing a lifestyle coordinator or activities director, however you want to call it, that helps implement and kind of run the activities calendar and the social schedule for those residents. At our more middle market products, we will peel back on the lifestyle coordinator and really let the residents run their social calendar, which works out very well.
Okay. So staying with you for a minute, Ashley, I have a question from the audience here. Can you speak to the learnings related to repairs and maintenance and ongoing CapEx? And how do those expenses compare to traditional IL or AL?
So because our retention is so strong, we actually have lower repairs and maintenance just in terms of unit turns and those costs. But everything else is comparable to what you would see in a conventional multifamily. I don't have the per unit or percent of revenue off the top of my head.
Okay. And can you be more precise possibly in terms of the lease up period for an active adult project in terms of the units per month, that type of measure?
Sure. Once again, we have product in markets coast to coast, so it really does depend on that and price point. But we're aiming anywhere from 6 units per month to 12. We've seen in some of our stronger leasing months. So we really have a lease-up period that's closer to 12 to 18 months. We're obviously trying to compress that as much as possible, but it's not quite as short as a conventional multifamily project.
Okay. All right. So Tom, let's talk a little bit about labor and more specifically staffing for Maplewood, but also for the Inspire. So is that, because you're a higher end brand, does that allow you to pay staff at different wages, or how are you anticipating that?
So the wage rates aren't necessarily different from our suburban properties. What's guiding it, however, is the fact that we're in New York and we have competing uses, whether it's a hotel, whether it's hospitals, different things. So really the wage rates that are in that community are really going to dictate. So a New York wage, more often than not, will be higher than something out this way. But then again, we have exclusive towns in Connecticut where there's no employees. So just going back, I think Melissa did a really good job of outlining the challenges here. And what we found again and again is, yes, we are in a labor crisis and it's not getting better anytime soon. And we need to do a better job of it, particularly with our line staff. And more often than not, a lot of our employees, it's just not about money. It's the healthcare, it's the benefit. They want a voice, they want to be appreciated. When you look at the turnover, that's a lot of the feedback that comes back. Of course, we have to be competitive with wages, and all the operators went through this during COVID. Do you give a one-time bonus? Do you kick up the pay rate, permanently with everyone, which you can never pull back? There was a lot of debates going on. So, but it is the 401k. It's career development. It's a lot of it is just peer appreciation in the culture that they're working in. You just can't underestimate that. They are all humans and they deserve to be treated that way. And, they're fabulous colleagues, they're line staff, and they deserve so much appreciation.
Okay, let's talk a little bit for the higher end brand about healthcare. So I know, is that something that you're working with as like a concierge type service? Are you helping people figure out their medical appointments and things like that? Or are people still pretty independent in terms of figuring that out on their own?
No, so at Inspire, we've created a lot of collaborations with New York Pres, Cornell Weill, and Mount Sinai. So we had spent about 2.5 years actually nurturing those relationships, and very close relationships with them, which has enabled us to provide certainly better care in the buildings. The type of residents at Inspire demand exceptional care. And I don't know if a lot of the folks on this webinar are aware, but the state of New York allows enhanced care, which is something in between assisted living and skilled nursing. So half the beds or units in our building are actually licensed as enhanced care. So we are able to offer more services to those residents, obviously preventing them from having to leave the building.
What's the age of your residents? Is it typical to what we would think of in senior housing, mid 80s, that type of thing? Or is it younger or older?
No, it's been about the same. I'm just looking at it on average about 85. I mean, it's similar to the national averages. I guess the one thing I would offer, New Yorkers live a long time. They're very healthy. They do a lot of walking. They climb stairs. So while I know it's 85, we don't know, but hopefully there'll be a longer longevity in the building.
Their lifespan might be different than their health span, I guess is a way to say that, right?
Sure.
Yeah.
Sure.
So a question from the audience is, how do the services that you offer at Inspire differ from like a typical CCRC? Because it kind of sounds like a CCRC in one sense. So how would you differentiate it?
The Inspire services, how do they differ from a CCRC?
Yes.
So we are not a CCRC, which means we don't offer nursing. We're not strictly independent. I mean, we're very focused on assisted living with an independent lifestyle, if you can read in between that. And we certainly offer memory care. So when I think about a traditional CCRC that's licensed that way, CCRCs have a buy-in component or a rental model. Excuse me. We're smaller than most CCRCs, and the level of care that we provide is different. Again, we're not providing skilled nursing services in our building. So it's a much more compact service, and I think that enables us to offer perhaps a better, more focused product. I mean, we're a very focused laser beam, whether it's culturally, medically, or the hospitality end of what we're doing here. In other words, we're not trying to cater to 3 or 4 different groups within a CCRC.
Right, you're more focused, more laser focused. Yeah. Okay. Melissa, there's a question here about the price point considered for middle market. So I know in the study that Nick did, the Forgotten Middle study, we assumed average annual outlays were about $55,000 a year for a full-fledged assisted living, and then we added $5,000 or so for out-of-pocket medical costs. So that came down to $4,000 or $5,000 a month ish. And depending on the market, that sounds higher or lower. But I think when you take into account all the services that are included in a typical assisted living, that would include, all your activities of daily living, your food, your accommodations, your housing, and all of that. And you were to compare that against someone who is in the home, it doesn't seem like such a staggering price point that it does initially on the surface. So in the studies that you've been doing at Leading Age Virginia, did you have any type of price point which you were thinking about as a rental rate for middle income? And if you did, how did that compare with what would be a more traditional CCRC rate?
Yeah, so ours assumed no entry fee. So that right there is a big differentiator from more traditional CCRC contract. And we built a 100-unit building, which is, we're calling it service enriched housing. So, you would have access to services. There's a certain amount of FTEs that are built into that. And our rent on paper was at $2,700 a month. So lower than what you're talking about. Again, it's not assisted living. You would be able to bring in services if you need them. We were trying to get to the $2,100 a month number. Again, we were looking at this in Roanoke, Virginia, so a more rural part of Virginia when we were building it on paper. But there are so many things that go into, and that's where I think our financial modeling tool is really helpful for providers, because you're able to put in how much common space do you need. So you have to consider, are you going to have a dining program? What type of amenities are you going to have? We were building it based on 3 different apartment sizes. And we were looking at it from the perspective of, would we have land donated? Are we looking at, really a greenfield construction? Are we looking at repurposing an existing building? We looked at examples like an old Courtyard Marriott. We looked at a school that already existed that wasn't being used anymore. So we were trying to be very, very creative in this. And, at least the model that we had on paper was $2,700 a month for rent.
And did it prove out, or did you be able to test it out, or what are your feelings about whether you actually could take a property like an old mall or a school or something to repurpose it for senior housing?
Yeah, I mean, we had some architects who were part of this that got really creative, and I could show you slides of what that Courtyard Marriott now looks like as a middle market product. We looked at what was already out there, so we built on paper. We also looked at modular construction. So you bring it all in flatbed trucks and you put it together like Legos. I don't think that's what Tom and Ashley are building. But again, we were looking at this from the perspective of, how do we take the mission that we have currently and expand it so that we can serve more people through that not-for-profit mission.
Great. Okay. So I want to take a couple minutes now and do what I'll call a lightning round. And that's where I'm going to give our speakers just like 1 or 2 sentence answers to go through some questions. We often do these at our conferences, and they're kind of fun and interesting. So Tom, I'm going to start with you. What is the typical household income for a resident in an Inspire property?
I can't give you the income, Beth, but I can tell you that the net worth typically exceeds $2.5 million. And it's certainly they're within the top 5%. There's a lot of wealthy folks in our Inspire project.
Okay. And Ashley, how about for active adult?
It varies by market and product type.
Okay. Melissa, any sense in the studies that you've been doing in terms of what the income profile would be for a middle income resident?
Yeah, so we were looking at households with 67 to 200% of median household income and up to 3 times median home value in assets. Again, we were looking at an income asset mix. So really looking at, if they have home equity versus if they have a pension and, what other income streams they have. But that's, again, we were looking at that segment who's right below the assets needed to move into kind of the lowest entry fee retirement community.
Got it. Great. Thanks. All right. Average length of stay. Ashley, let's just start with you on this one. I think you've sort of mentioned it, but let's go through it one more time. So for an active adult, the average length of stay would be
6 years.
What? 6 years. All right. Tom, it might be too soon to know that yet since your Inspire brand has only been open since 2021. But are you anticipating that the average length of stay will be in your pro formas and your modeling will be longer or shorter or the same as a typical senior housing project?
We think it's going to be about the same. And for our other portfolio, it's between 17 to 24 months.
Okay. Let's talk about ground up development. I know in the analysis that Nick has done on middle market, especially these days with the costs of development rising because of costs of materials, supply chain issues, inflation, cost of labor, lack of labor, et cetera, that ground up development is kind of challenging for middle market right now. But ground up development, I think, Tom, you had mentioned that actually ground up development might be the only solution or the only way to really capture the ultra luxury. So the question is, does ground up development make sense in ultra luxury?
It makes complete sense for us. We're very bullish on it. It's very difficult to take an existing structure, whatever it might be, and to convert it into something special, purpose built. As I say that, of course, the building that we're doing down on Embassy Row off of DuPont Circle was the old Ritz-Carlton Hotel from 1978. So that is one of the few examples where we're doing a refurb. But for the most part, we think it's easier, cleaner to do ground up development at least for our segment of the business.
Okay, Ashley, ground up development for active adult, does it make sense?
Yes. Obviously, it's market and demographic specific, but yes, it makes sense.
Okay. How about average price per unit? Ashley, staying with you in terms of the some of the round trips of the sales that you've had. Can you give us a sense of what the price per unit on a sales basis was?
So I can say that it trades at or a slight premium to multifamily conventional trades in each market.
All right. And staying with you, Ashley, again, in terms of the exit, you said that you were using core funds was one of the exits that you have so far been using. And the hold period on those properties were 7 to 8 years?
For our buyer or for us?
For you, as Carlisle, how long did you hold on to this?
Yeah, no, our hold periods have ranged from 2 to 5 years. Our goal is always to develop it, lease it up, and exit as soon as we can. So we're usually targeting 2 to 3 years, but these first generation deals were more in the 3 to 5 year category.
Okay. So we have some questions from the audience. Before we do that, though, up till this point, any other comment in terms of their lightning round that Tom, Ashley, or Melissa, you wanted to talk about? And the questions again were the typical householding for a resident, the average length of stay, ground-up development doesn't make sense, the average price per unit, and an exit. So, Tom, in terms of your partner, you said is Omega, so probably the hold on that is for some length, I would imagine, in terms of your looking forward pro formas.
That is correct. So I really just have to look at this metric as a cost, and our cost to develop these exceeds $1 million a unit.
Yep. Okay. Well. Okay. So, Melissa, any other thoughts that you want to share with our audience in terms of the opportunity in sort of middle market, or things that you haven't talked about, or things that you guys are thinking about now at Leading Edge Virginia?
Yeah, thanks, Beth, again for having me on here today. And I think obviously the opportunity is huge. This is a part of the demographic of the next age wave that really there aren't a lot of options, especially when you think about that care navigation piece, right? So that is one of the non-negotiables in our model, is that there be somebody similar to what we see in affordable housing with services, right? That will help the residents navigate care and access that care when they need it. So I think that is something that's really important, at least for our model. And then the last thing, kind of circling back to the workforce conversation that we're spending a fair amount of time on right now, is understanding the impact of the benefits cliff. So, there, and obviously every state is different, but many of our frontline workforce receive some type of state subsidy, whether that's, their medical insurance or food benefits. And at a certain point, when you start paying them more, they begin to lose that, and there becomes a gap for them. And that's called the cliff. And so we're spending some time understanding the benefits cliff and how it impacts our workforce amongst our Leading Age Virginia members. So more to come on that.
So is that acting as like a disincentive then to work longer hours?
It's a disincentive to develop on a career trajectory, because the more developed, the higher your hourly salary could go up. It could be a disincentive to work more hours. It could be a disincentive for many reasons because of that fear. And if you look at the numbers, a single parent with 2 children, you can begin to analyze what the impact of that increased hourly wage is. And so at a certain point, you think you're providing that living wage, and that could be creating a monthly deficit for that employee. So we really want to try and understand that as we're looking at retaining and recruiting.
Sounds like you guys are doing some really great research and understanding. So thanks for sharing that with us.
Thanks.
Okay. Ashley, other thoughts that you want to share that we haven't had a chance to talk about right now in terms of active adult?
I think I really want to emphasize that active adults should absolutely be part of the senior housing spectrum. I mentioned earlier that senior housing buyers have initially had a hard time paying lower cap rates for the active adult product, but as I mentioned, when you're looking at the risk-adjusted total return, the pricing is very justified. The return is higher for active adults at a 4 cap than buying for senior living at a 6 cap, and I think you're seeing that too when you have core funds getting involved in a senior associated product.
And what's been sort of for you one of the bigger challenges or one of the biggest surprises that you've seen involved, because you've been involved with the active adult of Colorado for a long time. So what's been something that was unanticipated?
Unanticipated. Well, I've mentioned previously, obviously the lease up is not like conventional. There's a little bit more challenging there. I think the resident involvement and how once the building is full, how the residents really take over the building, and it's their home and their activities, and even instances where we have a resident lifestyle coordinator or activities director at our more luxury products. The residents really end up taking over and running their own social calendar, and then you're just there in their home helping them. So I think that part has been the most the most rewarding
that's really interesting.
and surprising.
Yeah, it sort of speaks to the involvement of the residents and how they are a different resident too. They want to be fully involved, hence active,
Absolutely.
I guess. Yeah. So okay.
Yeah.
And Tom, how about anything that we haven't talked about yet that you wanted to share in terms of your product, your Inspire product?
Yeah, I guess one of the biggest challenges, but it's the biggest opportunity for us. It was creating the brand, establishing what that is. And boy, that takes a lot of creativity, thought, and perseverance from an organization to establish that. And by the way, a lot of money to do it. It's not easy just to take an existing brand and kind of bolt it on. So we started with the wholesale change there. The other thing is, at least in our segment, is when you start to play in big cities and you're doing, sky-rise buildings. Our building was or is 23 stories. Just the challenges, the land cost, the land assemblage, and by virtue of the fact that you're building a large building in New York like that, or any big urban city, there's a huge premium cost associated with vertical construction and great big foundations. Lump on top of that all the complexities with the bureaucracies. And our project in New York, we had the brand new MTA $10 billion line terminating right outside our door. So huge challenges for any of my peers in any city, certainly developing this. And then obviously you heap onto that the complexities with the programming and trying to create this amazing experience. So it's, I think the people who are going to do well and will be successful, again, it's mating the hospitality, the building design, and the integrative care. So that's the key to the whole thing. And you have to keep your head up here, really looking at that whole goal.
Yeah, that's true. We do have one question related to Inspire. Are adult children as involved with the decisions of move-ins as they would be in more standard senior housing?
They are. It's very similar to our suburban projects. Yes.
Interesting. Okay, well, I really want to thank you, Tom and Ashley and Melissa, for joining us today. I was a little worried about how we were going to get these are such divergent types of products. I was worried if we have a conversation that would be on the same page, but I think we have. I just find it really exciting. I've been in the industry for many years, we'll just say that, and to see that we're maturing into the segmentation by price point, as well as by acuity level and by the service offerings, I think is terribly exciting in terms of just the maturity of our sector. So again, thank you all three very much for joining me today. I would like you to, everybody who's listening, to stay tuned for our next NIC Leadership Huddle. And that's going to be something called Leading Through Change. And we'll hear from prominent industry CEOs and how they're leading their respective companies to achieve change and excel as organizations. You'll hear their keys to success as leaders into accomplishing organizational change, as well as the lessons they've learned along the way and how they can continue to grow. I also want to make sure that you have your calendars marked for the 2022 NIC Fall Conference. It's September 14th and 16th, so early in the fall, at the Marriott Marquis in Washington, D.C. Conference registration is now open, and the deadline to take advantage of the early bird discounted registration rate is June 29th. You can learn more about the event and the register for the conference on our website at fallconference.nic.org. And with that, I want to wish everyone a great day, the rest of the day, and thank you for joining us. And this will conclude today's Leadership Huddle. So thank you again. Appreciate everyone joining.